Hello YouTubers, and welcome back to the Independent Investor Market Update Part 2 for November 18th. Sorry about that last part of the video there. Power actually went out here briefly, so I'll pick up where I left off. I was talking about bonds, and the previous week I was talking about the flattening of the yield curve and how that can sometimes lead to recession, and how the Treasury Department, the U.S. government now, it almost looks like they're trying to, in my opinion, manipulate that curve a little bit. So what they're going to do is buy less long-term treasuries. So that would actually bring those prices back up, and buy more of the short-term. So that would bring that prices down, and that would again put the curve back so it looks like it's in a more normal shape that it normally is, with it curving upwards as the duration increases. So I mean, I've talked about this quite a bit, and this whole bull market really has been a lot by the Federal Reserve banks around the world, and their printing of money, quantitative easing, and it's kind of really thrown all the markets into a certain degree of disarray, and corrupted the fundamentals of how the markets have really worked in the past. You know, correct price signaling and that type of thing. It's becoming more and more about what the Fed's doing or not doing. They do continue to try bring their balance sheet down. They're saying now the Fed will allow $6 billion in Treasury debt to mature every month during the fourth quarter without reinvestment. So that should start bringing down their assets on their balance sheet, and it's just going to be interesting to see how far they can go. We're already seeing now some, as I was talking about, the junk bond market hiccups starting there. So, and it seems every time over these long cycles, when they increase rates, they can never go as far as what they did in the past. And and that's their main tool. We go into recession, they bring interest rates down. But in this case, if we go into a recession, they've only got interest rates back up to say 2%, then they don't really have that much room to come down and really stimulate the economy again. And again, it just seems we're towards the end of a large credit cycle. They don't even seem to be too concerned anymore about the deficit, government deficit in the United States. This tax reform here, I've read, it's going to add $1.6 trillion to the U.S. debt, which is already at $20 trillion. And we're supposedly at the end of a good economic run here, and this is a time you should be having small surpluses to actually pay down the debt a little bit, and then when you have a recession, they could actually increase government spending to help stimulate the economy. But that doesn't seem to happen anymore, even be talked about. So I go on to another thing I've mentioned again is the ETFs, and we're just seeing here's an example. Vanguard is kind of the pioneer in this, and again it's one of those kind of good economic theories that is taken to an extreme, and there's not one economic theory that you can apply to a market. The idea of buying an index cheaply, an ETF, is a good theory, because on average people cannot beat the market. But the problem is, when everybody starts doing that, the people that are putting money into the market, they really have no understanding of what they're buying anymore. They don't understand the valuation of the market, and as that takes a bigger and bigger portion of the market becomes less efficient. Because for the market to be efficient, there has to be investors knowing what the value is. Is the stock too expensive, not too expensive? So I see that, again, another issue. And so here, for example, shareholder net assets under management now is 4.8 trillion, and compared to just 1.1 trillion in 2009, with most of that money going into the low-cost indexing. They do have managed funds, but I think that's only like about 20%. So, well, here we go, 27% of assets under management account for actively managed funds, right? So, again, the 309 billion net inflows into Vanguard during the first 10 months of this year compared to 280 last year. So again, we've just got this rush of people just putting money in the market, not really understanding the markets, and at some point when these people start to lose a certain amount of money over a longer period of time, they're going to get scared. They're going to want to leave the market, you know, probably en masse, because they went into the market en masse not knowing. Because when it goes the other way, it's fear will take over, and they don't really understand if the stock market's 10% overvalued or 50% overvalued. So they're just going to panic and take it out and want to get their cash back and preserve their wealth. Where if they understood the market was maybe only 10% overvalued, and there hadn't been a large just a normal correction, and 10% is quite frequent in markets, they might say, okay, I'll leave my money in because I know it's going to come back up again. So it's all kind of confusing. So that's again, that's one of the main reasons I've gone to high kind of cash levels. Though I did buy one income producing property last week, and it's Crombie Real Estate Investment Trust. I've mentioned in the past, I do like real estate investment trusts, just because right now it's a way of generating income. And if you know where their properties and what they invest in, you can you know, have a fairly low volatile income investment. And Crombie REIT, what I like about them is that their main anchors are in their shopping plaza are drug stores and shopping centers, especially Sobeys. So people are always going there, like Shoppers Drug Mart, or going to the grocery store. So it's the retail side I want to stay away from, because there's been a big shift. People now aren't going to shopping centers. I've mentioned that. There's just been a complete destruction of a lot of retail stocks in the United States, up to like about 80%. Partially people shopping more online, but partially just people want to spend more on cell phones. They want experiences, so they'll go out for dinner, that type of thing. So I'm staying away from any REITs that have a large holdings in shopping malls, that type of thing. We've just seen here Sears go bankrupt, and if once Sears, a main anchor in you know, a shopping center, leaves, then that really drops the traffic for the remaining stores, because most people go to, say, Sears, and then they'll wander around the mall and drop into the other smaller stores, but they will typically not go to a big shopping mall for one of the small retailers. So it has a bit of a snowball effect. But I do like Crombie because it's got that continuing traffic, people doing their grocery shoppings, and this is a chart here going back a couple years, and it's been in a pretty tight range, like 12.5 up to about 15, and it was kind of on maybe in the middle of that range when I bought it there, around 13.7. It's jumped up a little bit. Again, REITs I've mentioned in the past, they do pay their distributions monthly, so I get on each share you get .074 of $1 each month, which works out to about 89 cents, which is a yield of about 6.5%, which is quite good right now in this market. So that's Crombie REIT. That symbol is CRR.UN, and that trades on the Toronto. Last week I mentioned about Capstone Mining and how copper prices were kind of coming up, and I wasn't sure if that was a long-term trend, and this is a company I trade in and out of a fair bit. The copper prices came off a bit last week, so I decided to sell about 80% of my holdings in that. I kept a small amount at a small profit. I've traded this one a few times in the past. It's just, there's so much different news coming out, it's hard to know if those copper prices were really sustainable. So I talked about the Silk Road in China, that type of thing, but then we hear a lot of other offsetting news. So I thought I had a small profit, I thought I'd lock it in. It kind of fell into my technical pattern, the pitchfork. So now I'm a lot more prone to sell on uncertainty, just because I think the markets are expensive overall and expecting quite a big correction. I'll speak a little bit about, I have in the past, but cryptocurrencies. And since June, as I mentioned, I opened an account in Coinbase, and I've just been splitting it, kind of dollar cost averaging between Litecoin, Bitcoin, and Ethereum, just because they're all have slightly different properties, and they continue to, they have bad publicity, and they get rattled. Investors get rattled, and the price drops quite a bit, sometimes 30–40%.